Well, good afternoon. My name is Fabien Labouret. I do work for Barclays, and I do run at Barclays the investment strategy group where we develop all Barclays custom indices. I'm tasked to make the introduction in English because we are hosting today English speakers. So all the discussion will be held in English. I hope you speak English. Otherwise, you might find it a bit boring. We have been actually working with Professor Shiller for quite some time. We started our collaboration with Robert Shiller about 6 years ago here in Paris, and then we engaged in lengthy developments to come up with indices that have been live now for more than 5 years, almost 6 years, 5 years, and we have gathered substantial assets leveraging of its publication on the CAPE ratio, cyclically adjusted pricing ratio. This has been a very successful collaboration. It has been a collaboration that we have expanded globally and across countries and across clients, but also in Europe, more specifically with other partners, with Ossiam, where we launched 3 years ago, and in fact we are celebrating around now the third anniversary date of the launch of our ETF with Ossiam, which is wrapping the Shiller index family, and they have actually raised about almost $2 billion of assets across the different products. So quite a successful collaboration also with Ossiam. So this development that we started that long ago has proven to be successful in terms of the ability to attract client interest, but also to deliver performance. The indices themselves had quite significantly outperformed the S&P for the US one and the other indices for the European and the Asian one. So successful collaboration because there was a good alignment of interest, and there was also a good element of trust that it allowed us to carry on for all these years. And we have expanded the family of indices more recently with Professor Shiller, expanding the range of indices to single stock. The first family of indices was on sectors, and we have launched the indices on single stocks as well. And more recently, and I let Natixis and Ossiam representative to walk you through that, we have actually engaged in discussions and launched an ESG version of that indices. So I'd like to thank you all for attending today. We'll try to make the session as interactive as it can be. So we have actually a moderator that will carry on the discussion, but if you have questions, raise your hand and we'll pass to give you microphones. Thank you very much.
Thank you, Fabien. Thank you very much. My name is Jean Rabi. I'm the CEO of Natixis Investment Managers. I'll kick this off briefly by just giving you a 30-second primer on Natixis Investment Managers and then moving on to introduce our guests. Natixis Investment Managers is a multi-boutique affiliate asset manager. We are part of the BPC Natixis group, so BPC is the second largest retail bank in France. What is less well known is that it's the fourth largest banking group in Europe by the size of its Tier 1 ratio. Mutual group, so provider of stability, of financial strength. Yet at the same time, Natixis Investment Managers is not an affiliate that is an asset management business that is captive from the network. In fact, the substantial majority of the assets we manage are for third party, i.e. true, not clients of the networks, nor the group itself. And that provides us with, I believe, the ability to attract, maintain, and help flourish a number of affiliates around the world. We have about 830 billion euros of assets under management, pretty much half in the US, half in Europe. We have 25 different investment affiliates. Now, that may sound a lot, and when I assumed leadership of this group last year, it was difficult for me to decipher what was doing what, but today I could tell you that in respect of each affiliate I look at, I know what they stand for. I know how the distinctiveness they bring to the group. And Ossiam is no different. Ossiam has been in the group for some time, has developed quite well over the past few years, and it's in part thanks to the collaboration we've had with Professor Shiller, whom I'll come back to in a second. But it's really provide a distinctive approach to the investment strategies that our group brings to our clients. And if I can just expand on that a second, the fundamental tenet of the group is investment autonomy of the investment affiliates, and on top of which you find centralized distribution, centralized seed money, centralized M&A expertise, centralized risk management and compliance that provides that in our view really helps the management teams focus on what they do best, which is roll out and develop and new strategies, new investment strategies, deliver performance. And for Ossiam, that's in a way that we believe is quite distinctive from other similarly situated ETF providers. And the new products we're announcing, ESG, are in that same vein. If we talk about ESG, it's fair to say that it has really developed a momentum of its own over the past 12 to 18 months. When I joined the industry last year, it was largely a talk in Europe. Increasingly, we see that in Asia and in the United States. That being said, this group stands for ESG in many different ways for a number of years. We have a number of affiliates that are signatories to the UNPRI, a number of affiliates which have established ESG policy that they embed in their investment processes, notably in this country or based in Paris. Two of our main affiliates, Ostrom, and the affiliate that's best known for that strategy, which is Mirova, which has a very sizable research group of the size comparable to the research group of BlackRock, for instance, which has exponentially greater assets under management. So this is something we take seriously, and the rollout of the ESG product today is no surprise. Shouldn't be no surprise to you, given how important it has been as a theme for us for some time still. Now, we respect investment autonomy of our affiliates, so they sometimes overlap, but by and large, given they are quite distinctive, they don't really compete with each other. They may compete for the attention of our clients, and they may compete for the attention of our distribution, but we think this is good emulation to ensure that we provide the best we can provide to our clients. Now, today we have distinguished guests that I'm happy to welcome. Perhaps from extreme right to right, Philip Coggan, who's a well-known journalist, financial journalist, one of the best financial journalists, and collaborates with my favorite publication in the world that I've been reading for the past 40 years, The Economist. Patrick Artus, who in this country and abroad is very well known for his diverse views, his iconoclastic style, always an ability to surprise us, and hopefully today he'll surprise us, given the current events provide quite a lot of material to further and to debate. And finally, Professor Shiller, who needs no introduction, a very well-known American professor, best-selling author, and in this particular case, so relevant to the development of Ossiam, with whom you've been a true collaborator for some time. So thank you very much for being with us, Professor. And on this note, I will leave the floor to Philippe. Thank you very much.
Thank you very much. Well, hello, everybody. I am Philip Coggan from The Economist. If you heard a very loud noise at 10 o'clock last night, that was me celebrating England's last-minute winner over the might of Tunisia. I know France beat Australia, so we're really playing the giants. But we're here to discuss the much more contentious issue of global markets, economies, and politics. I'm going to start on European politics. So a year ago, with the victory of Macron, it was some people prematurely celebrated the end of populism, but it was very much the French exception, as it turned out. We have now populist governments in Italy, Austria, Slovenia, and the German coalition is wobbly, to say the least. So, Patrick, how do you think that's affecting the investment outlook?
Well, I think two issues here. I mean, what we have today is very different from 2 years ago. 2 years ago, remember, before the elections in France, a lot of people thought in the markets that France might leave the euro. And that was a major disruption for the capital markets. No one here is suggesting that any country leaves the euro. So I think the situation is much less serious from a financial perspective than what it was in 2016. Now, what we have, I think, is two sources of concern. One you mentioned is populism, but populism today is mostly, populist parties are mostly concerned with immigration. So don't speak a lot about economics or financial issues.
Not even in Italy?
Even in Italy, I will be back to that in a minute. I mean,
yes.
I think mostly what you listen to is anti-immigration speeches and anti-immigration policies in most of these countries. This is a very serious issue for Europe, but it doesn't have a direct effect on the capital markets. I mean, Italy, I think, is a big concern for me because what we have, of course, is a populist party, but recent news seem to show that there won't be any very non-conventional policy put in place in Italy. I mean, more and more what we hear from Rome is that they will stick to the European guidelines in terms of budget deficits, that they will continue with structural reforms. So for me, the biggest worry in Italy is we should not expect that we end up with an enormous widening of the public sector deficit or of a very big increase in rates. I think this is not what we are really worried about because these people seem to be in reality very pragmatic. And basically putting in place these anti-immigration policies might be a way to hope that the opinion forgets that they will basically put in place none of what they've been discussing during the campaign. No minimum income, no big change in the pension system, no major increase in public spending on security. I think they are in the process of forgetting the whole of that. So, but what's the major issue in Italy? It's an issue in the macroeconomics of Italy. For 25 years, Italy has experienced absolutely nothing like an increase in productivity. Productivity today in Italy is lower than in the mid-90s. And when you've got a complete stagnation in productivity, everything turns bad. If you got a slight increase in wages, you end up with lower profits, then you have to cut investments. You end up with a worsening of competitiveness, and then you lose your market shares. And this is exactly what's at work in Italy. I mean, you've got lower profits, no banking crisis, making it that all companies in Italy had to cut their capex, their investment spending. You got an enormous loss in market shares on the export markets. Look at what it means. Italian exports during the last 25 years have increased 3 times less than world trade, which is really impressive. So this economy is a disaster. Where is it from? I think it's mostly from the enormous cost Italy had to suffer to enter the euro. In 1994, Italy was running an 11% of GDP budget deficit. They had to bring that back to 3%, I mean, in very few years. And most of that was done by increasing tax pressure on Italian corporates. So Italian corporates now are paying a very large tax pressure. Only France is above. And this is killing their profitability. And this has been killing their investment for many years. And again, on top of that, banks have stopped lending during the crisis 10 years ago. So what we have in Italy is a massive underinvestment by Italian corporates the last 20 years, which imply that there has been a big aging of capital, that productivity has stagnated. If you look at the production capacity of Italy in manufacturing, it's 20% below where it was before the crisis. So it's a disaster. Potential growth in Italy, if you calculate it as a normal way, it's negative. So you've got a country with zero growth forever. And the big worry I have is that the coalition is not discussing that at all. Not a word on investment, productivity, incentives to have more investments in Italy, to modernize the capital. So speaking about supporting the consumer, but nothing about the corporate sector. The big issue in Italy is a real weakness of the corporate sector. And if you don't change that, then Italy will continue with zero growth. And then there will be a more and more political crisis. If you've got zero growth forever, you just have to have political crisis starting, I mean, on a regular basis.
And isn't that the problem with Europe generally? It needs structural reform, as we always say at The Economist, but you can't get elected on structural reform. You get elected by anti-immigration, more spending.
Well, I mean, you got to do the right structural reforms. I mean, when Renzi in 2014 starting his labor market reform in Italy, was the Jobs Act, this labor market reform was fine. You had a new long-term labor contract. It was very well designed. So problem is that it did not address the rest. It did, especially, as I said before, it did not address the weakness in investments, I mean, which is a major issue in Italy. So you've got to do the right reforms, but you have not to miss something very important. The second thing, of course, about Europe is that the process of improving the institution is completely halted. We have a group of northern European countries, including Austria, Finland, Holland. I mean, we just reject everything like a change in the institutions. And basically, they reject everything like more solidarity between the Europeans. So basically, Macron is more and more alone. And this is, I think, a very big issue. Macron had a very pro-European stance in his program. He wanted to build a budget for the euro area, which would include common taxes or common bond issues. Nothing such will happen. So basically, today, there might be some very technical improvement, which is important for the markets, like transforming the ESM into some form of Eurozone IMF, which is not that a big task, by the way. It's already very close to a Eurozone IMF, like having an expansion of the Juncker program in financing more investments. But whatever means more solidarity is just completely stopped. It means no solidarity between sovereign issuers, which means that everyone is on his own, I mean, in case of a debt crisis. It means no more solidarity between the banks, nothing like a European insurance deposit system, for instance, which will be very important. Suppose you want pan-European banks, you need to have a pan-European resolution system for European banks, which cannot be done on a country-by-country basis, of course.
It means German money supporting Italian banks, perhaps? Or?
Yeah, well, you have to have it. If you want pan-European banks, they have to be very big banks. And you need pan-European banks because you need to have the lending habits becoming closer. You need to have liquidity circulating better. So you need banks operating through Europe. But then it's impossible if the regulation, not the regulation, but the resolution or the support to the banks is still on a country-by-country basis. So this is completely stopped as well. So basically, just to summarize, my biggest worry is not coming from fiscal policies. I think fiscal policies will stay in line with what was expected. My biggest worry is that we have a country where, of course, you can look at the French economy and see a lot of things are to be improved, like competencies of the labor force, like the education system. But when you look at Italy, everything is incredibly worse. I mean, and so we have a very weak country in Europe, which will stay in that position probably for many years, because it took 20 years to make Italy that weak. It would take a decade to improve Italy. So we have a very weak country, which will be a constant cause for some form of political unrest in Italy. And then we know that we have to live with the current institutions. And just a word on that to finish. The current institutions mean that the income inequalities between the countries keep widening. You've got a region where the countries specialize differently. It's Paul Krugman in 1992. It's still very true. And so you see the international specialization becoming more and more different. So the countries are more and more heterogeneous. And so on a spontaneous basis, incomes diverge, income levels diverge. You need some form of federalism to correct that. If you don't have that, then of course some countries will be poorer and poorer compared to the richest countries. But you will not have anything like federalism. So you will have this divergence.
And they're locked in the common currency,
yes. And so the poor countries, of course, will protest more and more, Italy. And the richest country will find it more and more costly to support the poorer countries. Hence the reaction in richer countries like Germany or Austria. So the fact that we have this divergence of incomes, I think, is absolutely horrible. It's really something which is extremely negative in a medium-run perspective.
Professor Shiller, your president has a lot to say about Europe on a regular basis. I just wondered, on the more academic, reality-based world that you come from, how the European economy looks to you.
Well, one thing that strikes me is the stock markets of Europe look cheap. As an American, I'm not being very patriotic in promoting our own stock markets. We have this CAPE ratio of 30 in the United States. In the United Kingdom, it's 21, and in Europe, it's in the mid-20s. So there's a big difference in pricing. I kind of think that has something to do with, well, it preceded Donald Trump, so it's not exclusively Donald Trump. But it's a kind of enthusiasm and confidence that, for some reason, pervades the United States right now and makes our but it's a good time to lighten up on your holdings of U.S. stocks, I think.
More than half the world index, MSCI World Index, the US. Well, we'll come back to valuations in a minute. Let's just, while we're still on Europe, look at monetary policy. So European growth in the first quarter looked pretty strong. In the second quarter, not so good. And the ECB has announced the end of QE, but keeping a sort of dovish taper, as it was called. Rates, they're ending bonds buying, but rates will stay at current levels for a year or so. How do you think they're handling it?
I think for me, it's very impressive to compare the Federal Reserve and the ECB. If I listen correctly to what the Federal Reserve is telling us, they're telling us, okay, we're getting closer to the end of the expansion in the US. You can debate for hours on what is the level of full employment or structural employment in the US. Unemployment now is down to 3.8%. We are not very far from the end of the expansion. Could be in 3 months away, 6 months away. That we are very close to there. And so my interpretation of the Federal Reserve is that they want to normalize before it's too late. Look at the dots. I mean, we have 2 more hikes this year, probably 3 hikes next year. The neutral rate is assumed to be around 3% in the US, so we should be there by the middle of next year. And basically, so I think the strategy is to be back to neutral, or even slightly above neutral, if you listen correctly, before if the economy really starts slowing down. The ECB has a completely different view of what they should do. The ECB keeps telling we are still very far from full employment, and I will be back to that in a minute because it's very important. So we have a lot of time ahead, and we still have a lot of underemployment in Europe, so we have to keep pushing demand. So of course they exit QE. Even for technical reasons, I knew it would be very complicated to continue QE. And then, as you know also, what matters for bond markets, it's not the flows of purchases, it's the stocks the central bank is holding. So the stock will stay at a very high level. So the effect on bond rates will be extremely limited, very small. But then they just told us, I mean, that they would be continuing the zero rate policy for 1 more year. Of course, it's logical from their point of view that the economy has still a lot of underemployment, but with still a very big output gap in Europe. And so they're feeling that the strong growth will continue for many years. So they have a lot of time to normalize, and they should not be in a hurry to start normalizing. Reality, I think, will be very different. I think the economy is already slowing down. Look at every single indicator, it's telling the same story. We also know that structural employment is probably much higher than in the past. The governor of Banque de France mentioned that structural employment in France was somewhere between 8 and 9%. I fully agree. So no way you can bring it back to 7%, the way it was before the crisis. So if you're at full employment now, of course, the economy will start slowing down now. And then what will happen, that the ECB will never be in a position to normalize its rates. They will be stuck with zero rates basically for the rest of times. So when you speak with the ECB, what they tell you is very interesting. They tell you, okay, we think you are wrong, of course. So we think there is still a lot of unemployment in Europe and underemployment. But if you are right, it's not a very big issue because then we will be using fiscal policy more. So we'll be using budget deficits. We'll reopen QE to monetize the deficits. And what's the problem? I mean, if you cannot use rates, then you will use the budgets and QE. And it's called Japan, basically. You got zero rates. Public debt goes to the sky, and you're stuck with zero rates for the rest of times, because if you were to start raising rates, you would cause a disaster because of the size of the bond portfolios in the economy. So I'm very worried that the ECB is very late in the cycle. But it's not a big surprise. Federal Reserve started QE in the late 2008. They stopped QE in 2014. The ECB started QE in 2015. In 2015, unemployment in Europe had already started declining for more than 2 years. So do you start QE when the economy is still very much improving? So they started, I mean, they were like 7 years behind the curve, or let's say 6 years to be kind with them. And they are still very much behind the curve. So they stopped QE in 2018. So they can start raising rates only in 2019, and it's too late because I think that in 2019 the expansion will be over. So we'll be stuck with zero. They completely reject this view, of course, because their view is that we still have this massive underemployment in Europe. But I think there's taking this big risk of never being able to normalize. And basically, I I prefer very, very much the strategy of J. Powell than the one Draghi is pursuing.
Mm-hmm. And Professor Shiller, I mean, as an economic historian, and with valuations on shares and property going back a long time, central banks are playing that much bigger role in the markets than they were 20 years ago. So how does it seem to you? Are we in a position where the central banks are permanently providing support to the asset markets, do you think? Or can we ever go back to the period where the Fed's and the ECB's balance sheets are much smaller?
It's interesting that in the wake of the financial crisis, excuse my voice, I have a cold, the term new normal suddenly appeared. And it suggested already in advance of what we've seen that short rates might stay near zero and even long rates might stay for a long time. This is a narrative. It's not implied by economic models as far as I know. It comes back out of, I think, a resurgence after the financial crisis of a Great Depression narrative. It goes back to the way people talk after having been in a depression for a long time. It was in 1938 that Alvin Hansen gave, as his presidential address for the American Economic Association, a speech that coined the word secular stagnation. That term had never been used before then. And he wrote a book about it. And that idea stuck in theory, but it faded in currency. We never forgot that term. But it came back with a vengeance when Larry Summers gave a talk about it just a couple of years after the financial crisis at the IMF World Bank meetings. And when you read his remarks, he was very tentative. He's a confident guy normally, yes. But he was remarkably tentative because he was bringing back a 50-year-old idea. But it went viral from his speech on, the idea that that interest rates will be forever low. Now, I don't know that it's based on anything except that maybe we're in a new regime where confidence is low and
well, one explanation is demography, right? That in an aging economy we won't grow as fast, and the other is the Bob Gordon thesis that new technology is not as useful to the economy as electrification and the internal combustion engine. I mean, where do you stand on that?
Bob Gordon wrote a fascinating book called The Rise and Fall of American Growth. And I was saying you should have deleted the word American from your title because you're writing about technology and it's the same everywhere. But he claimed that the world, or he may have said the U.S., had a remarkable century, which he calls the special century, which was from 1870 to 1970. And it sounds, I like the book, but I don't know if I like this conclusion, that all the really important things were discovered then. And what we have since 1970, the main innovations are in the realm of entertainment, computer games, the internet, which is entertainment. So I recommend his book because it's a story of technology and a story of how much it changed our lives between 1870 and 1970. In 1870, most homes didn't even have indoor toilets. And it was remarkable how people managed to live. I don't know how to evaluate something like that. You could bring him in as supporting the secular stagnation. The other thing is that the idea that we don't need heavy machinery anymore, and so we don't need as much capital. I think that's partly in his book also. Yes.
Before we go on to valuations, I just want to come on back to the Fed for a second. There's a sort of US saying, which I don't know, you don't have ketchup in France, but shake the ketchup from the bottle first a little, then a lottle. So you go like that, nothing comes out, and then. So the worry is with the Fed, you tighten a little bit, nothing seems to happen, but at some point you disrupt the markets because people have been financing themselves by borrowing at low rates, investing in property, corporate debt, whatever it is, and that turns into a disaster. are you worried
And then
about
there
that?
is just a word on
Sure, of
Shillers.
course, yes.
Yeah, I mean, yeah, but at the same time, if you accept that view, you never tighten anymore again. So if you never hike, you will never be able to cut. And that's so I think you've got at some stage in the middle of a cycle, you've got to decide that it's the right time to start tightening and to start normalizing. But what you're suggesting, I think, is more the ECB's view that it's too dangerous, basically, to start tightening. Federal Reserve, I think, is right. I mean, it's a counter-cyclical policy, so at some stage it has to remain counter-cyclical. And if you keep rates low for a short period of time, the risks you're mentioning are not that serious. I think it becomes very serious when you get low rates for a very long period of time. Take bond portfolios. I mean, the average duration is like 7 years. If you keep zero rates for 7 years, the whole portfolio has been transformed into a zero-rate portfolio, and then you die if rates start moving up again. If it's low rates for 2 or 3 years, it's not that a big concern. So I think, no, I don't agree with the idea that you should never retighten. Just a word on productivity. Just a word on, well, productivity. I completely agree. I mean, we work a lot on that as well. There is a lot of very interesting research. I want to just as a complement, both in Europe and in the US, on what happens today with IT investment, artificial intelligence. It's increasing the dispersion between firms. So for every single industry, what people call the efficient frontier, so firms with the best efficiency are improving very fast because of the new technologies. But you get a large majority of firms who are falling behind. And so the average is not improving, but in reality, you've got some firms are improving very fast because of the new technologies. And so people are wondering why we have this situation where the majority of firms seem not to benefit from the new technologies or internet, whatever you call it. And you got two answers. Basically, the Schumpeterian dynamics is not there. I mean, the bad ones don't disappear. They're still there. And you have two answers. Answer one is that, two answers. Answer one is that zero rates have been protecting these inefficient companies. And then when you start having higher rates, then they will disappear, and then the Schumpeterian process will be there. And idea two is the famous the leader takes all story. That you've got few companies in very single industry because of increasing returns to scale, being able to improve and to modernize because they become bigger, then their efficiency gets bigger, and then the others who are too small will, at the end of the day, will disappear. This is more consistent with a story where today we don't see an effect of IT on productivity, but it will happen. It will happen in the future because, again, in the future, this Schumpeterian process of having the inefficient companies disappearing will reappear. And so this is more an optimistic story that we see the efficient frontier becoming getting higher and higher. And just a very brief word on inflation. I think a very big problem one for central banks, I think, today is to assess the cycle. It's very complicated to measure the output gap. It's been a long-time problem for central banks. This is why a number of people argue that central banks should have a target which doesn't require to measure the output gap, like nominal GDP targeting, for instance. And question two is, where do we stand with inflation? And now the first bet of the ECB is to say, okay, we are still far from full employment, so we have a lot of time ahead to normalize. Bet number two is that inflation will reappear, but at some stage wages will start to increase faster and inflation will be back. I'm not convinced at all either. I mean, and look at the US. We have unemployment under 4%. Unit labor costs are between 1 and 1.5%. They are not moving up faster. So core inflation today seems to have disappeared even at full employment. And so the ECB can be wrong on both issues. It can be wrong on the cycle, it can be wrong on inflation.
I sense you're not a fan. Let's move on to valuations, and we've already heard mention of the cyclically adjusted price earnings ratio, as you are very much associated with it, Professor Shiller. Maybe you could explain for those people who don't know what it is, how it's calculated.
Well, John Campbell and I developed the cyclically adjusted price earnings ratio, thinking we were entirely new. Turns out we weren't the first to suggest the idea. I traced it back, in fact, to a Wall Street Journal article in 1911. They didn't name it, and they didn't pursue it. But the idea is that we tend to compute price earnings ratio as a measure of valuation using 1 year earning. either forward or lagged. But the question is, why 1 year? Well, there's an astronomical explanation for the year. It's the time it takes the Earth to go around the sun. But that's not the time that frame that business uses. So the next thing I found was Graham and Dodd in their 1934 textbook said, you should not use just 1 year. I mean, you should average it longer. 5 years, they suggested. But nothing got took. Barron's magazine had a price-earnings ratio, which they published for a long time, of price over 5-year earnings. But none of this took. So I think maybe what John Campbell and I did is a bit of econometric analysis. If we take price divided by 10-year average earnings, that forecasts about a third of the variation of long-term returns in the market. Now that might not seem inspiring, a third of the variation, but it's a way far away from the random walk story that efficient markets people claim. So so price, real price, divided by 10-year average real earnings fluctuates a lot, and it tends, historically, with data back to the 19th century, it tends in the U.S. to be mean reverting. Why is it mean reverting? When the price earnings ratio, when the CAPE ratio is high, it could go back to low, either by decreasing the numerator or increasing the denominator. Efficient markets would say it has to be increasing the denominator. Earnings will go up later because price can't be forecasted. But we found it's exactly the opposite. Historically, when the CAPE ratio is high, price tends to underperform or go down and bring the ratio back to normal levels. So we've seen this happening for over a century, and we found it also in other countries. So I feel quite intuitively confident that this thing is a stable phenomenon, and we can expect it in the future.
But the critics would say it moved well above the historic average in the mid-90s.
Right.
It fell a bit after the dot-com bubble.
Right.
And fell in 2008, but it never returned to the kind of below historical averages you would have expected of such a bear market, and then it went back. So those people would say, well, over time, the CAPE should be higher, accounts is better, business is better run. What would you say to those arguments?
Well, they do bring a little bit of doubt to me. I'm not 100% confident of anything, and especially with regard to forecasting the stock market. But I can say it does remind me of a remarkable book written by Irving Fisher. It was published in 1930, and it was called The Stock Market Crash and After. Now, of course, I've never met him. He died before I'm born. But I feel if I could ask him, he was writing the book in 1929 before the crash, and it had no forecast of a crash. In the 1930 book, he predicts it to come back up. Why? He sounded exactly like you just did. He said, investors are getting smarter. They have failed to recognize that the stock market has long outperformed all other investments, and that the price-earnings ratio has always been too low. But now we're entering a new era. He was also famously quoted by a newspaper in September of 1929 saying that the stock market has reached a permanently high plateau. That's what you just said, isn't it? Oh, you didn't say it. You were questioning.
I was paraphrasing other people to be fair to me.
But they are saying that. So Irving Fisher lost everything. He lost his house. Yale University had to give him a place to live. He lost his relatives' money. So I think it's a sad ending to his life, because the thing he's most remembered for is saying what you just said at the worst possible time. So the question is, are people more sophisticated? Is stocks have been historically underpriced? Are they getting it this time? Well, it depends on your view of investors. I mean, how smart is the average investor? And I guess I have a different view. And I think we're going to likely revert back to lower price earnings.
Just before I bring Patrick on it, another part of that criticism is, obviously it's a 10-year average. I think your first 10-year average from I've used your website many times, is in 1881.
Yeah.
So you have 137 years of data, so that's only 13 completely separate
Right.
time horizons.
We have other countries too.
Yes, but can you really be statistically confident that things revert to the mean when you have a relatively limited set of discrete periods to
There's
analyze?
also, it's worse than that because it's also an endogenous variable problem. So Campbell and I wrote a paper on the significance, and but based on Monte Carlo experiments, and we concluded that it is likely to be significant. 13 observations, as you say, does establish some. You can get with 13 observations, you can get high significance. But I have to say, I'm not 100% sure either about this.
Right. Patrick, what do you think? Do you think the CAPE is a good guide to the fortunes of the market in the short term or the long term?
I'm worried about something which is creating a big buzz, which is buybacks, equity buybacks.
Right.
Because we are, and this is very different in the US or in Europe. In Europe you have gross buybacks. In net terms, stock market is still expanding. In the US, you've got a very large net buyback. So every year, the US stock market is destroying like 3% of the number of listed stocks. And so basically, I did a piece where you compare earnings per share or in the stock market indices between Europe and the US, and you correct for buybacks. And then you think that you find that's just the opposite of what you seem to see in reality, that the European market has been overperforming the US market at all times. The overperformance of the US market is only due to buybacks. So basically, what does it mean? Today, the number of listed stocks is only the half of what it was in 2000. So if you go to 2040, there will be one stock left. It will be worth $20 trillion. And then you will say, my God, I mean, the valuation of the US is very much higher than in Europe. I mean, so I think at least we should correct for buybacks. I think this is creating an enormous buzz if you compare Europe to the US. I mean,
I have a paper with Farouk Givraz at Barclays on this. It is true. You're absolutely right. Buybacks distorts the CAPE ratio somewhat. It makes it a few points higher, and it's artificial. But at Barclays, for our CAPE product, we use total return CAPE, which is not affected by buybacks. So I think that we're okay on that. But it's very good to point this out, that the stock market, if you just plot the data, the U.S. stock market, part of that is, and showing the big increase, part of that is just spurious. It's because of a new trick. I have another book, by the way, with George Akerlof called Fishing for Fools, The Economics of Manipulation and Deception. This fits well into our book, this idea of buybacks.
Yes. And maybe we can tie the valuations in with a productivity argument. So one argument for the higher profits is that the economy has moved in favor of capital relative to labor. Technology means, very high earnings for companies which can exploit the network effect, Google and Facebook and so on. So the ratio of profits to GDP is higher in the US than it was in previous cycles. And it can be sustained that way. So what ought to happen if the capitalism was working properly is lots more businesses would be created to take advantage of the high returns. The competition would drive returns back to normal. In practice, that hasn't happened, as we've been discussing. So therefore, to use the permanently high plateau argument again, that stocks are worth more because technology means we have this sort of elite world and the rest of us, poor schlubs who are on minimum wage. And that means you have very high returns on equity and profits.
No, I think it's a second difference, you're absolutely right, between the US and Europe, is that income sharing has been completely distorted in the US. Wages have been increasing less than productivity in the US for the last 25 years. And this, of course, has a huge effect on profitability. So most of what we see, I think, is macro. Nothing to do with the efficiency of individual firms, or maybe some monopoly rents in large internet companies. But this is a minor thing compared to the fact that real wages in the US have been increasing by 1 point less than productivity every single year since the late 90s, which you don't see that much in Europe. I mean, so this is creating a trend, an upwards trend for profits. which is really due to the functioning of the labor market. It has nothing to do with, again, with the efficiency of US companies. So the big question mark is whether this will continue or not. I mean, can you have the continuation of this trend where and so 30% Americans with the lowest incomes have the same real income as in 1990, I mean, 30 years ago. I mean, so can you continue with that? And this is basically a crucial thing. I think you want to assess, not in the short-term perspective, in the long-term perspective, you want to assess equity markets. You've got to go to that. I mean, what about income sharing? I mean, do you continue to have an increased share of profits in GDP forever? It's not due to the necessity to have more capital. If you look at the capital to output ratio, it's not increasing. A part of that might be a bit misleading. It's due to the lower price of capital goods. But then if you calculate the capital to GDP ratio, it's about flat. So you don't need to have a higher income and capital. And one argument you already mentioned before, so that the share of services in the economy is bigger. So the capital intensity of the economy becomes lower. So basically the increase again in capital income in the US has nothing to do with the increase in the capital intensity of the economy. It's just the fact that companies are using their power to depress wages. So there's a major social problem behind the stock market, basically.
So, Professor Shiller, what about that? The FANGs, Facebook, Amazon, and so on, have distorted the market?
I think that there is a powerful narrative afloat about just this, that income inequality is getting worse around the world, and it has something to do with technology that rewards a special set of people. This, in my third edition to Irrational Exuberance, I put this as one thing that might be driving the market up, because people feel the need to want to. They feel that they're losing something. They don't feel vital, and it's actually an ego hit as well. And so one thing they want to do is own something, own tech, and that tends to drive the price of these things up. But you know, we've had similar fears before, many times in history, going back to the Great Depression and back to the Luddites. And
yes.
It hasn't. People are often reassured that nothing dramatic has happened yet. But the question is, people are starting to think with the rapid advance in computer technology in the last since the financial crisis, that this is the turning point. I think it's I can't explain narratives. I'm writing a book about narrative economics, but I'm trying hard. Narratives have a complexity to them, and simultaneously contradictory narratives will float at the same time. But I think that there is this narrative about inequality and about machines replacing jobs has the potential to really affect behavior. And it just takes the right twist or the right circumstances, and we might see a big pullback in consumer demand or willingness to hire people that could bring on another crisis.
And may explain the rise of populism, of course, as well.
Absolutely.
So I wanted to talk about a couple of your other ideas for new instruments to try and deal with. So one example is the idea that you could sell your lifetime's earnings or share in your lifetime's earnings in advance. And maybe you could talk about that. And also the idea of GDP-linked bonds as a way of governments raising money, avoiding some of the traps of recessions and so on.
Yeah, I've written a couple of books about this. I have a new one with the Bank of England and IMF on sovereign GDP-linked debt. So it seems like modern theory of risk management gives us a lot of potential. It's a powerful idea, the idea of diversifying, hedging, but they haven't always been applied to real problems that people face. So after the fire of London in 1666, it was a vivid enough experience that they were able to convince people to buy fire insurance on their homes. But even so, they didn't do it in great numbers. It's hard to sell people on these ideas. They sound strange. We now have fire insurance. Almost everyone has it now. It's institutionalized. But we don't have many fires anymore because we have much better fire retardant things, and we have fire departments that prevent, like the fire of London, from happening again. But I think that we have other issues that can be perfectly well dealt with. So by financial or insurance techniques. So one of them, you mentioned GDP-linked bonds, was something I've been advocating. They should have done this long back, decades ago. The governments should link their national debt to the GDP of the country. The simplest thing would be to sell shares in GDP. Call those trills. 1 trillionth of your GDP would be the dividend you receive every year. And these could be traded in markets. But the beauty of them is that countries like Greece, whose GDP declined by 25% after the financial crisis, would have seen its debt go down by 25% because of the indexation. And this works. Every country should be issuing GDP-linked debt. Why don't they? I find there's a sort of inherent conservatism. Now, another thing is livelihood insurance. I'd like to see people encouraged to take risky bets with their human capital, because that ultimately leads to progress, but not to bear all the risk themselves. So if I go into some highly abstruse technical field, I might turn out to be in demand in 20 or 30 years as an engineer or whatever. But if I'm not, there's nobody who can bail me out. We have venture capital firms that will take on very risky ventures, but they don't do individuals. So what I call livelihood insurance is something that could be offered by insurance companies. Or the other idea you alluded to is you could sell shares in your own income. This idea actually goes back to Milton Friedman in his 1963 book, Capitalism and Freedom. However, he said in that book, this is a little bit far out for today. The problem is that, but I think with the information economy, we can do more things. We can make insurance policies that you could buy on occupational incomes, and we could back that up by making the insurance, it wouldn't have a moral hazard problem. The insurance would settle on indexes of occupational income.
Just to come back on the GDP-linked bonds, there's a lot of investors in the room. They might, when you mention Greece, they might think, Greece, didn't they fiddle all their statistics? Would you buy a used GDP bond from the Greek government? They might.
Actually, I'm not pitching to the Greek government right now. I would like to see the United Kingdom do it. The United Kingdom showed great
dodgy statistics too, but yes.
Well, not that dodgy. The United Kingdom really got, I think, the inflation index bond market started when they issued inflation-linked bonds, and they did it in scale, and they did it with the information that they would continue to do this, so that people in the financial community thought, well, we have to knuckle down and understand these now. They're going to be happening. With that impetus, we actually have inflation-linked bonds, which are important. The United States first tried inflation index bonds in 1780, the state of Massachusetts, and not again until 1997. But now they represent over 10% of the national debt, which is a lot of money. No. I think that innovation tends to proceed slowly. But we should be guided by innovations that affect things that matter a lot, like global warming. All the talk of global warming, virtually all of it, is about how we can stop global warming. Well, personally, I'm feeling pessimistic, more pessimistic now that we have President Trump, that we will solve it. But I'm thinking that the effects of global warming will be borne unequally. Some countries might actually, Canada might benefit from it, and other countries will be devastated by it. So we want to start now. What we should be talking about is making risk management contracts that protect them against this as yet unseen catastrophe.
Yes. You might care about it when Mar-a-Lago gets flooded in the next hurricane. Let's move on to risks, talking of Trump. So if you're thinking about the possible risks before we bring in questions facing the global economy, what would be uppermost in your mind, Patrick?
Just a word to just as a
Oh yes, great.
Well, I have a bit of a problem with GDP index bonds, because if a government sells an inflation-linked bond, the investor in the bond can use that as a hedge because he has to pay more in case inflation is higher. I'm looking at an investor who would use a GDP index bond as a hedge against anything. If I invest in a Greek bond, if there's a recession in Greece, what kind of hedge can it be for me as an investor? I just could not figure that out. But just
the capital asset pricing model says, if you accept that as a starting point, that everyone should invest in a mixture of the risk world portfolio and the riskless rate. And everyone should hold it. But you cannot hold the world portfolio now because most of it is not even securitized. It's GDP. What is the income of the world? It's measured by their combined GDP. So what you should do is invest, according to the CAPM, since you already have a stake in your own country's GDP, you want to hedge that, short your own bonds, and buy the rest of the world. And this works. This is risk management.
Okay. It's the same idea as telling that we should have more diversified portfolios with less home buyers in the portfolios. Just an additional word before answering your question. So there's a very important debate, I think, currently in the EU about the necessity of having some form of a restructuring process for sovereign debts. So including the possibility that we have an organized default or restructuring of sovereign debts. And I don't have the answer. I just asking to myself the question, is it really a good idea? In principle, it seems to be the case. Basically, if you don't succeed in having a very strong fiscal discipline, then you should accept the idea that you may have more debt crisis, and at the end of the day, you got solvency crisis, so you got to restructure, and it has to be done on an organized basis. I mean, and we know that the big mistake made with Greece was basically to disguise a solvency crisis into a liquidity crisis. But if you start that, if you tell the markets, okay, guys, when you invest in a sovereign bond in Europe, at the end of the day, there is a default risk included, you're changing completely the nature of this bond. So in principle, you should accept the idea that it would be a positive thing to have this form of a organized restructuring process. But in reality, I think it would lead probably an enormous worsening of the perceived quality of the sovereign debt in Europe, and you don't know what it does for rates or spreads. Just a footnote. On the risk, basically, a question we have to ask to ourselves, but Professor Shiller would have a lot of idea probably, is do we have currently a very big risk hidden somewhere? Is there a big black swan hidden somewhere? And I think it's a question we should ask to ourselves at all times. So I just have few ideas. Christine Lagarde 2 weeks ago said the risk was the level of debt, especially in emerging countries. Now, it depends very much on the rates. Today, rates are well under the level of growth. So as long as it's the case, normally debt is not a real problem. And you look at Japan. I mean, if you can keep zero rates for the rest of times, but debt probably is a possibility. Trade war, of course. I mean, so just let's have a simple estimate. The worst you can expect from a trade war is that you lose, in terms of the loss in GDP should be the value of the tariffs. This is a worst case scenario because it corresponds to a situation with no substitutability between imports and domestic production. So if you got a tariff on imports, you don't produce more, you get the full cost of the tariff. If you do that today, if you look at what's been decided so far by Donald Trump, the cost for the US economy is a half of a tenth of a point of growth. So we still don't have a big macro effect of trade war, but it could continue. So people speak a lot on the markets of liquidity shortages. I think we have to be very careful here because, for instance, when people look at the bond markets in the US or in Europe, they look at what the local central bank is doing. But what we need to look at is global liquidity. Bank of Japan is investing in OATs and treasuries and bond. The Central Bank of China is investing in bonds. And so it's money creation in China or Japan which matters, not only money creation in the US and Europe. If you look at global liquidity, which is basically the size of the balance sheet of every single bank, central banks taken together, in May, it has been increasing by 14% year over year. So even though the Federal Reserve is out of QE and the ECB is speaking about exiting QE, at the global level, global liquidity is expanding extremely fast still. So we have some tensions on the short-term money market in the US. It's due to a completely different factor, which is a repatriation of earnings to the US, which has a big effect on money market funds. But at the global level, you don't see liquidity shrinking. And now I can stop there. So if you got an idea, I'm very pleased. I mean, because we need to look at, in the US, I think people should look at commercial property in the US. Commercial property prices are increasing extremely fast, like 8-9% a year. Residential property, I think, is a very robust market. If you look at the scores of the
in the US, or
in the US, but commercial property is not that sufficiently monitored. And I think in the US, you start having something looking very much like a bubble on commercial property.
Sorry, Professor Shiller, of course, you called the top in residential property in the US, and how do you see property valuations at the moment? How do they look?
We have our own S&P Case Shiller home price indices that have been going up since 2012. And initially at 10% a year, and now more like 5 or 6% a year. That's a pretty strong inflation, but it's not strongest in the U.S. Vancouver has been crazier, and Australia, New Zealand, Hong Kong, Shanghai, places like that. I don't claim that I can forecast the end of these booms, but it probably has something to do with I come back to my idea of narrative economics, something about the stories we tell about ourselves that encourage us to buy a big house and compete with others on that. It has something to do with Donald Trump. You mentioned Mar-a-Lago. Donald Trump offers a role model, which is a very powerful role model for a lot of people, about conspicuous consumption. It's not a dirty word, and having anymore. It was in the past. I'm thinking these days in terms of powerful narratives. You bring up another one, trade war. So I'm interested in that narrative. So what is the narrative? I think, tell me if I'm wrong, it's a Great Depression narrative. It is that in 1930, the U.S. Congress passed the Smoot-Hawley tariff, which raised tariffs substantially. And other countries were angered, and they raised tariffs more. I don't know what you think. Did the U.S. retaliate again and raise? I don't think it did, actually. I think the story is kind of a legend, like Robin Hood or something else. It's not researched that. It's not.
I'm just reading a 700-page book by Douglas Irwin on this very issue, but
I haven't read it. Okay. But that's another sign. It's the narrative of today. Now, I'm not in support. I actually signed an open letter opposing Trump's policy. But also, Trump tells a very combative. You've noticed, he shows anger a lot.
Yes.
He's fun to watch if you like to watch angry people, emoting people. So there's something in the atmosphere about trade war. So I'm thinking that the way a crisis could happen, it could be tied to the incipient trade war this time, because we think it's so important now. Back in the 1930s, it wasn't as prominent as it is now.
1,028 economists wrote to the New York Times saying that the Smoot-Hawley tariffs were wrong. It's very interesting.
Well,
Nobody listened, of course.
I think they were wrong, yeah. But it wasn't the main cause of the Great Depression.
No, it wasn't. Let's open up to questions. You probably have views on your own, the risks that you'd like to hear the experts talk about. I think there are microphones somewhere up there. Yes, there are. So if you can raise your hand, please, and then we'll see if any questions. Yes, there's a gentleman here, and then a gentleman in the row in front of him.
Thank you so much. I have a question for Professor Shiller. What about EPS? Do you readjust your EPS between tax policies, accounting rules, and creativity of CFOs?
Well, I would like to get into the whole history of earnings. I found it's difficult to find historians who are interested in how they used to do accounting. I met one once, but he wasn't very helpful. Earnings. Well, one problem with earnings is that we already have a Financial Accounting Standards Board in the U.S. and similar organizations elsewhere that recommend accounting practices and keep changing them. So you might get, if you actually get on FASB website and look at all they talk about changing rules, and they open it for discussions about changing rules, there's a lot there. They're always changing the definition of earnings. So it's a little bit, earnings is a bit of a slippery concept. We know what we're trying to measure. I'm not going to second guess FASB in my analysis of earnings, because I have faith that they are trying to hit a target, which is an honest representation of how well a company has done in an interval of time. And often the changes are due to the fact that corporate practices, for example, they give more employee incentive options, and the question of how you account for them has to be resolved at some point after they start doing that. So we don't go in and adjust earnings. That would be a huge task. Maybe we should someday. That's a scary, big task.
There was a gentleman in a row in front. If maybe we can pass. Oh, is the microphone gone again? Yeah.
Yeah, sorry. I have also a question for Professor Shiller regarding the GDP-linked bonds. If I am an average French worker and you suppose that my salary grows with my country GDP, for my retirement, should I invest in foreign countries' GDP-linked bonds? So basically, today we invest in our home sovereign debt, and then maybe in 50 years, if your idea will be well widespread, we should start investing in the US growth or Germany growth or Japan growth. What do you think?
Well, I've made the point that countries are like families, and that in a traditional extended family, there would be 3 generations living in one house: the children, the working adults, and the retired elderly. And I think that that's what they do is like a metaphor for what countries should do. The first thing is, you don't tell grandma and grandpa living with you, we're going to guarantee your income against anything, and it's fixed, and the rest will come out of the other generation. Nobody would do that, right? You're a family. You share across all 3 generations. If there's good news for all 3 generations, they should all share in it. Or if it's bad news, they all come back. So there is this aspect of sharing. But the family, when it invests its portfolio, it should invest it internationally and not locally in their country.
Would there be the danger, though, that Greece might be happy to issue GDP-linked bonds because it fears its GDP might fall, but China, which we all might want to own the GDP of, won't issue them because it doesn't see why it should give away its growth to...
There's always moral hazard problems. And one thing that we talked about in my book with Benford and Ostry is that we need rating agencies to rate these securities against things other than just the usual practice that they go through. And they've never done that. So that's one of the barriers. We need a new kind of expertise.
Any more questions? Patrick, oh yes, there's one.
So few decades after the Cape, you provide a sort of strategy for financial markets. But for narrative economics, do you have some ideas to build portfolio based on the fact that the financial market is like a dynamic of opinion and stories?
Right. Well, I'm coming out with a book on this, but I don't expect to finish the field. I think that we are undergoing a revolution in economic research, not unlike that of the revolution that started in the Great Depression of the 1930s. In 1930, no country published a reliable wage or unemployment figure or a GDP figure. All of this accounting, all of these new numbers were new in response to the Depression. And the kinds of things that were produced then led to an era of econometrics where they would build computers were new. You're coming in shortly after that time. Computer models of the economy that would track GDP and consumption and construction and all, but these are all government statistics, pretty much. There was no confidence in these models. There was no animal spirits in these models. That was just an epoch, an era. But now we are, first of all, we are not much more, there's been a behavioral economics revolution, and we're now much more aware of psychology. There's a neuroeconomics revolution, where we're now understanding the human brain. And there's a data revolution that we now have digitized. We have digitized newspapers, books, legal records, church sermons, diaries. We know it, and we have all these social media. We know what people are, we can do big computer analyses of what people are thinking. But it's still a daunting task. But I think this is the beginning of a change. More and more people, and it affects investment management too. More and more people are doing some kind of computer search of some kind of database to find evidence about what the narratives are that are driving things. And I think it's going to take decades for this kind of thing to play out. I was involved in the behavioral economics revolution that we started. Dick Thaler and I started our seminars at the U.S. National Bureau of Economic Research on behavioral economics in 1991. Well, that's a quarter of a century ago now. But I can see it happening again now. There's going to be a lot more research that affects what you do and what stabilization policy does. It comes from studying narratives.
And Patrick, as a working economist, do you have too much information? I mean, there are numbers that come out every day. You've got to spend your time worrying about purchasing managers' indices and all this stuff. Or do you? And are there any new bits of data that you look at that are more useful than the ones that we traditionally look at?
Just as a complement to what Professor Shiller said, I think econometrics have become extremely different. Now, when I started this profession, I mean, like in the 1970s, 80s, we were estimating these big macroeconometric models. No one would dare do that these days. So we have moved toward panel data econometrics, and I think this is a very powerful instrument as well. You're looking at the behavior of hundreds of thousands of people over a long period of times, and this is and basically you learn a lot because it's micro information. Like with microeconometrics, I think is proving a very, very efficient instrument. Just an illustration in the case of France. I have a good friend, I mean, at École Polytechnique doing his research on the retraining system. So he has built a panel of 500,000 French, especially more younger people, over 20 years, and he looks at what happens when these guys go through the retraining system. And he proves that very significantly they reduce their probability to find a job, which is, of course, proving the efficiency of the system. I mean, so I think microeconometrics, I think, has become a very important instrument. What I said before about the effects of IT at the firm level, it's based on, of course, microeconometrics. So I think this is really what I use more. I had a very interesting discussion with one of the people on the board of the ECB. He told me, you know, the problem with the ECB, that we have too many models. And we have so many models who tell very different stories that we don't know which model we should be using. I mean, but I think microeconometrics, again, has become a very, very useful tool. And just if I can have a second item, I think we are today, I think, in a situation where the long-term trends are extremely uncertain. You would argue that it's always been the case, but still just 4 things, I mean, which I think where we have a lot of uncertainty. We already discussed IT and productivity. We don't know what happens with productivity. I mean, Bob Gordon has all these explanations. You can share some of them, but not all of them. B, income inequalities and growth, which is also one of Gordon's argument, that income inequalities are, in long-term perspective, destroying growth. 3, what is the real determinant of long-term inflation? It's not money supply. Look at Japan. We have an explosion of money supply. Inflation is negative. So we don't know really what's determining long-term inflation. And so how do you invest in long-term index bonds if you don't know where long-term inflation is coming from? And D, organization of production. We see today, I think, that we are desegmenting the value chain. people produce in less places, closer to the consumer, which is a complete break compared to the last 30 years. Just for example, so I think we have an enormous amount of uncertainty, especially affecting long-term growth and long-term inflation. So it's much harder to invest. Huh?
Yes. Now, we started 10 minutes late, so I think we're about to time, if I'm just looking at the front row. Yes. So it only remains for me to ask you to thank our two experts very much for what they've said today. Thank you very much.
So I'm Bruno Poulin, I'm CEO of Ossiam. So I just noticed that I'm just in the middle of you and the lunch. So probably I won't survive for longer. And so I just want to thank you again, gentlemen. That was a real pleasure. I think probably you got a feeling of the luck we have to work with such guys. Patrick actually is a member of our scientific council, and so with both, so we have been working on the strategy for some years. So I hope that you got a perception or a feeling about the luck that we have at Ossiam and Barclays to work with this guy. And Philip, thank you very much for moderating this debate. And so now you are, I would say, free to go to the lunch.
Thank you.